Hello and welcome back to my channel Learn Property Valuation with Dr. T. In this episode, we are going to consider premiums in leasehold transactions. So a premium is a lump sum that is usually paid by a tenant to a landlord at the beginning of a lease in exchange for a lower rent. Sometimes a premium is paid in exchange for a particular advantage in that property. The advantage may include something like a good location or a particular facility that gives the tenant an edge. So this premium is what connects valuation theory to practical negotiations between landlords and tenants. From the valuer's perspective, we consider how do you know or how do you calculate what exactly a tenant should pay in premium, or in some cases, when a premium is already agreed on, how much rent should be received from the tenant. So in this episode, we're going to be looking at various scenarios in which premiums are calculated, how they are calculated, and when they are used in practice. Let's begin. All right, so let me just reiterate that a premium is a lump sum payment made by an incoming tenant to a landlord or an outgoing tenant in addition to their rent in exchange for a lease. So it is usually based on negotiation between the landlord and the tenant. Okay, and if you look at my screen, I have stated a couple of scenarios in which a premium can be operational, right? The first one I stated here is that when a landlord is willing to take a lower rent than the FRV, but he's taking the premium upfront. So it's almost like, okay, just give me a part of the rent I'm going to be collecting for the next few years or upfront. And then another scenario is when an existing tenant subleases his interest in a property and enjoys a profit rent which may be capitalized to reflect a premium. So, for instance, tenant A has taken a property for 1 million naira, but then he wants to sublease that same property at the same rent of 1 million naira, but it's saying you can continue with the rent I am paying, but give me a premium, which would be my own profit from this transaction. Okay, so that is also a case of a premium. And another case is where the tenant is willing to pay an extra sum just to secure a property because of a particular feature that they would like to enjoy from that property. Like I stated here, the feature may be advantageous location, especially in cases of commercial properties. You want a shop in a particular place or on a particular floor just because of what it can do to your business, and you are willing to pay an extra amount for that. That extra amount is known as the premium, right? So when we do valuation, we as valuers, we may either be tasked with ascertaining what the appropriate premium should be, or ascertaining what the appropriate rent should be after a premium has been paid. So the question could go either way. It could be that you are tasked with ascertaining the premium or ascertaining the appropriate rent after a premium has been paid. So I've just tried to summarize everything I've said here on my screen. You can just look at that for details. So let's go and look at one question where we are calculating for the premium. Now this question says a freeholder is granting a 15-year lease of a commercial property. The current FRV is 3 million naira per annum. The freeholder is to receive a premium of 5 million naira on grant of the lease. The all-risk freehold yield is 8%. Calculate the rent at which the lease should be granted so that the freeholder's total financial return is equivalent to letting an FRV with no premium. So this question now wants us to calculate what the rent is given that a premium has been paid, right? And the correct approach when you're doing this kind of valuation is to do your calculations from both the viewpoint of the lessor and the viewpoint of the lessee, or the viewpoint of the landlord and the tenant. They're definitely going to have diverging views, but when you do from both views, it allows for negotiation between both parties to say, okay, maybe we can find a common ground. So let's start by looking at the lessee's point of view. So we say lessee's viewpoint. Can do our naira signs. All right. So because we're doing it from the lessee's viewpoint, we're going to use the full rental value, because once again our basis is that the landlord should not be worse off than if he was collecting the full rental value. So we say our FRV, from our question, our FRV is 3 million. And then we subtract the annual equivalent of the premium. Now, if you have not already checked it out, please go to my YouTube channel and check a prior video where I explained how you arrive at the annual equivalent of a sum. So the annual equivalent is also known as the annuity 1 naira will purchase. So please go to the video and check out what it means and how it's calculated. So we are going to subtract the annual equivalent of the premium paid, and that is 5 million naira, which is the premium that has been charged, times 1 divided by YP 15 years at 8%. So we got all these details from the question. Okay, and then that gives us 5 million naira times 1 divided by 8.5595. So the answer to this is 584,146. So if you do the calculation of everything we have here, this is what it gives us. All right. So if you subtract this from the full rental value, it will give us the rents to be reserved, which is 2,415,854. So from the point of view of the tenant, he is not supposed to pay more than this. Okay, you can say it's approximately 2,400,000. This is what the lessee believes that he should pay. But then let's look at it again from the point of view of the lessor, which is the landlord. So we say lessor's viewpoint. Okay, so when you're doing the lessor's viewpoint, you have to look at the present interest and then the proposed interest. You know, he now is the freeholder, so it's like you're doing the term and the reversion, right? So let's look at the present interest. So for the present interest, once again, we use the full rental value as our rent passing, okay, because the question has said he shouldn't be worse off. So for the full rental value, we have our 3 million naira, and then we do YP in perp at 8%, right? Our YP in perp at 8% multiplied by that gives us 37,500,000 naira. That's the current interest without a lease. That's his current freehold interest without a lease. Okay. The proposed interest is going to have a lease in it, which of course is going to be less than the full rental value because a premium has been paid. So the proposed interest is going to have a rent reserved that we do not know, and that is what we are trying to find. So we put it as X because we don't know what it is. Okay. Yes, and then we multiply it by an appropriate YP, which is YP. For this question, it's a single rate, so YP 15 years at 8%, and that is 8.5595. Okay, and that gives us 8.5595x. And for the reversion, so this is for the term. This is for the term. So for the reversion, we have, of course, it will revert to FRV. Please also check out our term and reversion video for details on how to appropriately or accurately do a term and reversion valuation. So for the reversion, it will revert to FRV, 3 million naira. And then we have your YP in perpetuity, in perp deferred, 15 years at 8%. Please, I'll talk about these rates when I finish the calculation. At 8%. So YP in perp deferred 15 years at 8% simply means that he doesn't begin to enjoy the FRV until after this lease expires in 15 years. Also check out the video on how to calculate the YP in perp deferred. So this gives us 3.9405. Okay, and when you multiply that, it gives 11,821,500. Then we add the premium. Okay, because now this interest that we have valued does not include the interest that was the premium that was paid at the beginning of the lease. So now we have to add that premium to it. So we have the premium of 5 million naira to add to it. So now what is the total of the landlord's interest, proposed interest? So this isn't part of it, right? So it is just, we add these three, this and this and this, and then that will give us 16,821,500 plus 8.5595x. So what we are solving for, what we are looking for exactly is this x, okay? And there is a rule of thumb that the lessor should never be worse off than he was before the premium was negotiated. So what that simply means is, at the end of the day, he shouldn't be getting anything less than the full rental value, right? And then his present interest should be equal to his proposed interest. His present interest should be equal to his proposed interest. So based on that rule of thumb, we would say that his proposed interest, which is 16,821,500 plus 8.5595x, is equal to his present interest, which is 37,500,000. Okay. So now we're going into pure mathematics, because what we are looking for is we are looking for x. So 8.5595x is equal to 37,500,000 minus 16,821,500, because we have brought this 16 now to the other side, it becomes negative, right? And that gives us 20,678,500. and then our X is 20,678,500 divided by 8.5595, because we are now bringing this to this side, it becomes divided by, and then that gives us 2,415,854 per annum. So from the lessor's viewpoint, this is how much the tenant is supposed to be paying. As you can see, it's less than, sorry, it is more than, so from the lessor's viewpoint, this is how much the lessee is supposed to pay after paying the premium. Now, if we compare that to the calculation of what the lessee came up with, we find out that they are quite similar. That is not that's not something that usually happens, and I'll explain why that happened. The reason why we're having similar values from both the lessee's viewpoint and the lessor's viewpoint is because of the rates that we used. Now, if you noticed, when I was doing the calculation, I used the same rate all through, 8%. That is not practically, that doesn't happen practically, right? First of all, I used one rate just for explanation's sake and not to confuse you. But usually in practice, especially when you are calculating the reversion of the lessor's viewpoint, right, there's always a slight increase in the yield rate used for reversion. Now, why? If you watch the term and reversion video that I did, I explained that when you are doing your valuation for reversion, it is assumed that it is a riskier investment because it is income that is receivable in the future. So yield is usually a reflection of the risk of the investment. The riskier the investment, the higher the yield rate, because the investor uses the yield rate to compensate for risk. So a riskier investment should have a higher yield rate. Now, income that is receivable in future is riskier than income that is receivable currently. Cash at hand is more, it's more secured than cash that you are going to receive in future. Anything can happen. Anything can happen to the property. Anything can happen to the market. Okay, so usually I should have increased the yield rates used for the reversion, and once that rate is increased, it will definitely affect the value of the property. So it is not every time that you see the same value on the leasehold, on the lessee's viewpoint as it is on the lessor's viewpoint, because the yield rate would have been different. All right, so I just wanted to put that there. So whenever you are doing a valuation that reflects a situation where the income is likely to be threatened by risk of anything, it could be inflation, it could be anything, it should reflect in the yield. There should be a slight increase in the yield rate. So all these things are reasons why we say that valuation is subjective, and that is even the more reason why we say when you are stating your valuation, you don't say that the value of a property is actually this, because nobody can say that. Everything we do is an estimation. It's subject to the perspective of the valuer, is subject to the various circumstances surrounding that property at the time. So we have another question here, and this question says that Chief Okonkwo owns a freehold commercial property at Awolowo Road, Ikoyi, Lagos. The property has a full market rental value of 18 million per annum net on FRI terms. Also check videos on the different terms in income method of valuation so that you can understand what terms like FRI and FRV mean. Chief Okonkwo needs capital urgently to finance another development project. He therefore decides to grant a new 12-year FRI lease to a corporate tenant at a reduced rent of 11 million naira per annum, on condition that the tenant pays a premium at the commencement of the lease to compensate for the shortfall in rent. The appropriate capitalization rate is 9%. Calculate the annual rent forgone by Chief Okonkwo. Calculate the premium that Chief Okonkwo should charge the incoming tenant. So, unlike the previous question where we had been told that a premium had been paid and the amount for that premium was given, and then we were tasked with ascertaining the appropriate rent to be received. This question now tells us the rent that has been negotiated between the landlord and the tenant and wants us to ascertain what the appropriate premium should be. Okay, so let's state the facts first. So our FRV is 18 million naira per annum net. The term is 12 years. Rent reserved is 11 million naira per annum net. Premium is unknown. Let's say X. And then the interest rate is 9%. Okay. So, the first question says we should calculate the annual rent forgone by Chief Okonkwo. That's simple. So if the full rental value, annual rent forgone will be equal to full rental value minus rent reserved. And our full rental value is 18 million naira. Our rent reserved is 11 million naira per annum. So that means that the annual rent forgone is 7 million naira per annum. So Chief Okonkwo is losing 7 million naira per annum. So the next question now says we should calculate the premium that Chief Okonkwo should charge the incoming tenant. So based on what we said earlier, that the rule of thumb is that Chief Okonkwo should not be worse off than that his proposed interest should not be worse off than his present interest. So if he was getting FRV, right, he would have been getting 18 million naira. But now because he's getting lower than FRV, he's getting 11 million naira. So how much should he charge upfront so that he's not at a loss? Basically, what we need to do that is to capitalize the value of the rent forgone. Okay, so capitalize it over the period of the lease. Right? So it's 12 years and at 9%. So we'll say the rent forgone, which is 7 million naira, and then we capitalize it by YP 12 years. YP 12 years at 9%, and that gives us 7.1611. So our premium will be 50,127,700. So it's approximately 50 million naira. So for the landlord to be not to be disadvantaged by this transaction, he should take a premium of approximately 50 million naira at the beginning of the lease, and then the tenant can pay 11 million naira over the period of the lease. So that's how premiums work. It's simply trying to make sure that nobody is missing out of the transaction, whatever the transaction is or whatever the agreement is that has taken place between the landlord and the tenant. So as usual, I'm going to leave you with a question that I want you to practice with, and you can put your answers in the comment section for me to review for you. Now, this is a bit longer than the ones we've done before, and this is a typical case of one tenant subletting the interest to another tenant at the same passing rent, but they want to take a premium for it. So let me just guide you as to how you can go about these calculations. So the question says 7 years ago, Zenith Enterprises Limited was granted a 15-year lease on a warehouse at Amuodofi Industrial Layout, Lagos, at a rent of 5 million naira per annum. The lease has 8 years unexpired, and the current FRV of the warehouse has risen to 9.5 million naira per annum. Now, Zenith Enterprises no longer requires the warehouse and wishes to assign the lease to a new tenant, Transcargo Logistics Limited. Now, Transcargo is willing to take over the lease at the existing rent of 5 million naira per annum, but must pay a premium to Zenith for the privilege of occupying the property at below market rent. So the first thing is calculate the profit rent enjoyed under the lease, and that's simple. Of course, you know that the profit rent is simply the FRV minus the rent reserved, so you figure that out. Then the second question says calculate the premium using the YP dual rate with a remunerative rate of 11% and a sinking fund rate of 3%. So once again, go and check for my annual equivalent videos, or the annuity 1 naira will purchase, because it will now come in handy here, because so for question B, we are just going to follow the same thing we did in the previous question. We are going to capitalize the profit rent to get the premium. So that profit rent that we got from question A, we are going to capitalize it with the appropriate YP, and then that will give us the premium. So for question C, I would advise that you go back and check out my video on how to calculate the annuity 1 naira will purchase, also known as the annual equivalent, and use it for this question C, because it says using the annuity 1 naira will purchase at 11%, calculate the true annual cost of occupation for Transcargo, that's the rent plus the annual equivalent of the premium, and compare it with the market rent. If you run into any problems while trying to solve this question, just put it in the comment section and I will help you out. Once again, if you are yet to subscribe to this channel, please do, so that you can have access to more valuation content. Also, like the video and share with a friend. Thank you very much, and see you in the next video.